Well, the annual rate of inflation has fallen more than expected to 2.8% in the September quarter. Joining us live now is one of the country's top economists, Saul Eslake. Saul, good to see you as always. Thank you. Break this down for us. What could these numbers mean for interest rates?
Well, at first glance, you might think that today's numbers increase the probability of a cut in interest rates at one of the two remaining board meetings the Reserve Bank's going to have this year, because headline inflation is down to 2.8%. That's the lowest since the year to the March quarter of 2021, and it's within the Reserve Bank's 2 to 3% target band. So what's not to like? Well, unfortunately, the decline in the headline inflation rate was largely purchased by the government's extensive rebates for electricity bills, that's federal and most state governments, by the increase in Commonwealth rent assistance to pensioners and other beneficiaries renting in private housing of 10% over and above the normal indexation. That reduced the rate of rent inflation. And thirdly, the fall in petrol prices during the month of more than 6%. Now, when you look at the Reserve Bank's preferred measure of underlying inflation, the so-called trimmed mean, which X's out the top 15 and bottom 15% of price changes, whatever they happen to be, then that underlying inflation rate was 3.5%, which was which is still significantly above the top end of the Reserve Bank's 2 to 3% target band, and not nearly close enough to it to give the Reserve Bank the confidence it says it needs that inflation is sustainably returning to its target band to contemplate cutting interest rates at either the November or the December meeting. So yes, the headline number was good, but the underlying number was, though better than it has been in the past two quarters, nonetheless nowhere nearly good enough to justify any expectation that there'll be a cut in interest rates before Christmas.
Okay, so we won't hold our breath for that. More broadly, when you look at the state of play, Saul, are we, do you think, heading for that economic soft landing that the Treasurer likes to talk about so often?
I think we are, but it's taking longer to get that landing than the Treasurer and financial markets, at least earlier this year, had been hoping. The Reserve Bank has been targeting a soft landing by starting to raise rates later than all of its peers and by raising its interest rate by less than all of its peers. The cash rate in Australia, as everyone will know, is 4.35%. The US Federal Reserve raised its equivalent of the cash rate to a percentage point higher than that, and it's now cut it by 50 basis points. The Reserve Bank of New Zealand raised its cash rate to 5.5%, having started about 9 months before the Reserve Bank of Australia did. It's now cut its interest rate by 0.75 of a percentage point, including a 0.5 of a percentage point cut last week. The central banks of Canada and the United Kingdom likewise raised their cash rates to 5 and 5.25% respectively. The Bank of Canada has cut its rate now by 75 basis points, and the Bank of England once by 25. But all of those countries, though they've got inflation down more quickly than has occurred here in Australia, have paid a higher price in terms of increases in unemployment, particularly the Canada and New Zealand. The unemployment rates there have risen by 1.4 and 1.6 percentage points respectively, as opposed to just 0.6 of a percentage point increase in the unemployment rate here. So the Reserve Bank's been trying to achieve a hard landing. That's meant that although interest rates haven't gone up by as much as in other countries, they're going to take longer to start coming down, but less of a price has been paid in terms of jobs than in other countries. And so while there are people who are critical of the Reserve Bank for going softer on inflation than their peers in other countries, there's a plus from that, in the sense that the unemployment rate hasn't risen nearly as much, and in aggregate, Australia hasn't experienced any job losses.
So that's always appreciate you joining us with your analysis. Thank you so much.
It's a pleasure. Thank you for having me.